There we go. So today I wanted to talk about the tightening of financial conditions that are going on. I think they're much tighter than people think. But we have a lot going on in the world today with the lockdowns in China getting worse, Russia continuing to target critical infrastructure in the Ukraine, the fallout from in the crypto market from FTX, which, by the way, I'm thrilled to learn that Michael Lewis has been shadowing Sam for the past 6 months. So I'll finally be able to understand things about crypto that I didn't when he writes his book next year. We have ongoing concerns about inflation, the global recession, but last week somebody asked a question about who to listen to from the Fed, and I wanted to kind of reflect on that, and I actually botched the answer, so I want to clarify that. But I also want to share some results from a paper that was done by the San Francisco Fed on why conditions are tighter than we think and tighter than the Fed funds rate would reflect. So let's jump into it. So I want to just start with about the Federal Reserve. It's our central bank. There's three big entities with it: the Board of Governors, the 12 regional banks, and the FOMC committee, which sets the policy. You have 5 key functions, but it's really about price stability. It's about full and maximum employment, and it's about ensuring that the system operates the way it should with the right safeguards and consumer protections, and that the payment system flows properly. So the Fed actually is all about monetary policy. It's about influencing the availability and cost of money and making sure it's consistent with the goals we have as a country. We've been doing this since 1913. The FOMC is 7 members. It's the 7 members of the Board of Governors, and then it's the president of the New York Fed, and then it's 4 of the 11 Reserve Bank presidents who rotate annually, and they hold 8 meetings a year. There's 1 more to come. The Fed funds rate, I want to put this in perspective because we've been in such an unusual environment for the last decade that sometimes we take it for granted what a zero interest rate environment actually meant relative to our historical numbers. So as you can see here, for most of the time, the idea of getting to zero on the Fed funds was not a big part of the thinking. So the Fed's only policy tool was the adjustment of the Fed funds rate. With the tech bubble, and then you had the Great Recession, they added new tools. And now with the pandemic, that's even put greater emphasis on these tools. The 2 new tools were forward guidance, which was to try and get the market aligned with where the Fed was going so there'd be fewer surprises by giving you a sense of what the forward path was going to be. And then balance sheet policy. So giving the market a sense, market participants and consumers a sense of what future policy was going to be would allow them to adjust their spending and plans accordingly and make their investments appropriately. It really started in 2003 and became even more critical in 2008 when we introduced zero interest rates. The balance sheet policy really became a big tool when we started QE in 08, and it's really important when you're doing large scale purchases. So just to give you a sense of the balance sheet element of it, you look at this going back to 2003, and you can see for the longest time throughout our history, we were not anywhere near a balance sheet of $1 trillion. And then in 2008, we jumped from $1 trillion to $2 trillion. And then as we got to the European debt crisis, you had another step up to 4 trillion, 4.5 trillion, which we stayed there till 18 and started coming back down again. And then the pandemic hit, and you can see the big jump up to 7 trillion, and then the last jump up to 9 trillion with the 1.8 or 1.9 trillion stimulus last year. So that kind of gives you the background. Who should you listen to? The 3 keys are Powell, obviously, is the chair, Lyle Brainerd, who's the vice chair, and Michael Barr, the chair for supervision. I would also add the New York Fed is the other chair you want to pay attention to. There are others that you want to listen to. The other voting members for this year would be, aside from these 7, would be Maister out of Cleveland. It would be Bullard out of St. Louis, one of the more vocal and more hawkish Fed members. Susan Collins, who was actually more dovish with her comments, and Esther George, who was at the Kansas City Fed. Susan Collins replaced the guy who left in Boston. So the San Francisco Fed was looking at how to think about the new policy tools that we're using, how to measure, as develop a proxy measure for Fed funds. And this is following a report that was done in 2016. And they wanted to take a broader look at what the key indicators would be that Fed funds impact. So they looked at all the treasury rates, they looked at mortgage rates, they looked at credit spreads, they looked at 12 different factors. And they said the Fed funds rate alone does not capture what is really going on in the tightening or easing of conditions based on these other areas. And based on where we are today, they're suggesting that conditions are much tighter than the Fed funds rate would indicate, which is part of what I think is creating some confusion for the markets. So let's take a look at going back to 76. They took their Fed funds rate in the blue and the proxy rate in the green and overlaid them. And you can see they've run very tight until about 2003 and then 2001 with the tech bubble. But in 2003, when you started to see the Fed get a little more unconventional in their policies to try and bring the economy back out of the tech wreck, and then you started to see it get more aligned as their guidance was very much in step with the market. And then you had the beginning of with the financial crisis of zero interest rates, and you started to see the divergence of the market, the proxy rate getting easier than the Fed funds rate. And then fast forward to today, you can see it going the other way. So to bring it back in and look at a much more narrower scope and look at 09 to 21, and you can see the differences highlighted much more clearly. When the Fed was easing and conditions were easing, they're easing at a much greater rate than the Fed funds rate would indicate, because we're putting massive quantitative easing on the system then. And then you fast forward to 19, we started talking about Fed bringing rates down. They were starting to talk about the reversal of the balance sheet expansion. And then you started to see the proxy rate come down to be back in line with where the Fed's funds rate were. So when we're talking about tightening, you see the proxy rate move up. And then when you talk about easing, it moves down. But now you can see with all these changes, if you think about the reversal that I've talked about the last couple of weeks of putting $125 billion of treasuries and mortgage-backed securities into the system and now taking out almost 95, you're seeing a $250 billion reversal in capital. And as we know, inflation's a monetary phenomenon, and it goes both ways. When you're adding money into the system, like we did in the last couple of years, you're going to get this big inflationary move. When you start to take it out, you get in tightened conditions, you get the opposite effect. And what you're seeing here is that conditions are actually tighter, and according to the proxy rate, than the Fed funds rate would indicate. So what does this mean? I think we're in a very unusual spot where you had the Fed using new tools, and the tools have been hard for the market to interpret. And they're harder to interpret because they're using new tools on a system that's very different than it was in the past. And what I mean by that is when we had recessionary issues in the past or inflationary issues in the past, we didn't have rates at zero and we didn't have unemployment at such low levels. And that means we're going to be in a very different spot for where we're going. And the Fed's guidance and the use of quantitative easing and quantitative tightening is very different than what we've seen in the past. So the market really needs to look beyond the Fed funds rate and look at the other factors. I've talked about the dollar too, which has tightened considerably, it's strengthened considerably. Now it looks like it's going to ease, which should take some pressure off as well. But we've had a lot of tightening going on that are not captured in the Fed funds rate. So we believe the conditions are tighter, that the Fed is not as likely to have to raise rates as high as some of the hawks have talked about. But we also think they're going to keep them at a higher level for longer than a lot of people think, because they can use the tools of the balance sheet to also create different types of pressures on the system. So Jim, I'm going to stop there and open it up for questions. And I apologize. I, like Mark, am fighting a flu for the last week or so.
No problem. We appreciate your tenacity, Stephen. So questions, comments?
Yes, Stephen, question for you regarding these metrics, the Fed funds rate, CPI, and what have you. is there, I mean, many of these metrics have been developed decades ago. How are these metrics being adjusted and replaced? Is my
Yeah,
question.
That's a great question. That they're looking at how to capture a lot of stuff that they haven't captured right in the past. And one of the hardest things is capturing the impact of technology and GDP. You know, there's a lot of value creation that's not fully captured yet. So they're looking at this. This is why the different areas of the Fed, the different research groups will look at these other factors and say, how are other things impacting it? And I think it's really interesting because the market is very much about the real focus is on the Fed funds rate and just the benchmark rates, but you really have to take into account all the other elements that go on, the dollar being a big factor in tightening and easing of conditions. The quantitative easing is so new and we've gotten it so wrong from the very start. If you think about when quantitative easing was first introduced, we're going to have runaway inflation. What people didn't factor in was the easy money was going to allow spending to create more productivity until you had then the troubles that hit later on where we started to see productivity went to the side because we had the pandemic and supply chain issues that created bigger snarls. So I think that they're trying to look at these things, but you can't change history's data and then get everyone to jump on board and say they're going to believe it. So it's a very difficult thing, Adam, to incorporate new factors in when the world's changed so much.
And I think it's important, again, I sound like a broken record, but how much the Fed's been politicized.
Yep.
Greenspan was a political animal and it's gotten worse, progressively worse, less quality leadership and more political influence and much more short-termism. You know, I actually got to know John Taylor and he should have been the Fed chair because the signal that the Fed, you know, well, and the balance sheet, that I think is the elephant in the room as far as Fed policy is concerned, is that balance sheet. I mean, the Fed has lost so many of its levers because of a politicized path they chose. You know, it was politically expedient and they didn't want the reality of the pain. Where's Paul Volcker when we need him? You know, we needed that pain to be inflicted much sooner in the cycle, and now they've lost their levers.
I agree, Joe, but I also would say that I think the Fed's gotten a lot more blame than they deserve too, where the politicians who are making the blame are a big part of the problem for this extra spending they did when the economy was relatively strong last year.
Absolutely. Oh, they're not blameless. That's where it ultimately should. I completely agree. I completely agree with you.
That extra 1.9 trillion was probably not necessary. Certainly was more than a little inflationary.
Well, yeah, and using Japan's central bank as your role model is like, really?
Yeah.
That's just, to me, it was a colossally adverse signal and tactic at the same time.
Yeah.
Both.
Andrew?
I'm going to defend quantitative easing. It's easy to look back on 2008 and 2009 and
I got to go on mute then.
Yeah, you can put me on mute if you want to hear this. Quantitative easing was what allowed a incredibly crippled economy, not just a financial system, to ease its way out without more pain from 2008 and 2009. Quantitative easing did not result in inflation. In spite of all of, 95% of the policy papers written about QE a decade ago were all about runaway inflation. It never happened. And quantitative tightening, when it was happening, wasn't that painful when they started to unwind the balance sheet. The fact of the matter is that inflation is not caused by monetary conditions right now. It's been we haven't had any immigration in America in 3 years. Our labor force is shrinking. We don't have enough people for the jobs that are available, and that's what's leading to inflation right now. Housing is actually, and I recommend everybody follow Bill McBride at Calculated Risk blog and sign up for his Substack as well, which is excellent. But housing is coming down so much faster than the Fed ever thought possible. The Fed is way out on its skis right now in terms of monetary tightness. M2 has collapsed, absolutely collapsed. And I don't think I think they're so short term right now. They're looking out a month when they should be looking out 6 months or 9 months. So
I would just support what Andrew said about the Fed in the early stages. I think the issue was when, and this goes to Joe's politicization, when MMT became such a key part of the last couple of years' policy process, that's where we lost it. The idea of quantitative easing in the early stages was absolutely essential to avoid what I think would have been a deflationary system that would have been catastrophic back in 08. But then when we kept going on without the inflation, it emboldened the MMT folks to say, see, we don't have inflation, so we can do even more. And it's typical of the US system. If a little bit's good, then a lot is going to be really good, and way too much is going to be even better. It doesn't work that way when you're dealing with deficits and debt. And people always forget that debt is the current consumption of future earnings. So you have to be careful with that.
And I go back, I think it was 2010 or 11, when Bernanke wrote an op-ed piece in the Washington Post. Now that would have been absolutely, I'm sure Paul Volcker threw up in his mouth when he saw it. Because if you go back and look at the article, one of the justifications for that policy working was stock market was going up. He put that in the op-ed piece. Well, that's not the Fed's job. And yet that was the rationalization, and that gave him cover, obviously political cover, as well as cover for his own policies. When in fact, the root cause of 0809 was a structural regulatory issue, goes back to Brooksley Born. So they didn't solve the problem. They just threw more morphine in the system. And that's the problem I had with it is, yeah, they saved the system by bailing out the people that caused the problems to begin with. And that's what was wrong. And if you watch the, was it Too Big to Fail? You can see the machinations of just how over the skis they were. That was the movie that was the book that Andrew Sorkin wrote about the inner workings of that whole saving of that process and how it was determined on the fly. And that's the problem I've got with it, is that literally when the signals were a decade before, and yet they did nothing about those signals. She was right, and yet that still wasn't implemented.
Joe, my partner, Arnold Schmeidler, actually spent an hour and a half with Volcker around that time, talking about the system. And Volcker, his comment was, well, Arnold told him that we're in a mess, that the Fed can't do anything right. He said, I agree. So there was actually, they were in a bind, they were in sideways. And I think that's part of the problem. Bill and Paul, you have your hands up. So
Yep. Paul, why don't you go first?
Sure. Thanks, Stephen. Yeah, one thing when we were talking about the Fed, kind of like, pulling money out of the system. I've been studying deposit rates across banks. So, especially CD rates, and there is pretty big difference across banks. And also, you're seeing kind of capital or cash getting pulled out of certain banks for better deposit rates, different CD rates. So do you see, I guess, has the Fed really, what's your view on, like, has the Fed really studied this, how it's affecting certain banks in terms of capital flows? And also, like, I'm thinking that there are going to be some banks that actually have to sell assets because their deposit levels draw down to a certain level because of these, chasing of better rates, like small banks, not large banks, but and they're going to actually have to sell loans. And that's what I'm seeing. I deal a lot with the structured credit side on whole loans, and I'm seeing starting to think small banks are going to have to sell loans to kind of cover their lack of deposits because of their lower CD rates.
Yeah, I'm less worried about the US financial system than I am any other financial system, but I do think you're right. The smaller banks, some of them are going to be on the wrong end of this and are going to get exposed. But I don't worry about really run-on banks or like we've had in the past, like the the savings and loan crisis or anything like that. I don't think we're in that kind of a mode.
I'm thinking more, it's not a run on banks, but it's like it's going to be an not massive asset sale, but you're going to see significant more asset selling, which are going to affect other banks because it just drives, the value of loans down more. I mean, they don't have to sell their loans per se because they have the deposits, but they have to have higher, they have to have the higher rates to kind of match those, their higher deposit rates. So you may see, more selling across the board, and it just lowers asset values.
Yep. Well, in the type of environment we're in, you're going to see lower asset values with rates moving up. That's one of the elements of it.
Yeah. Sure.
The housing, as Andrew pointed out, is dropping like a rock right now with 7% mortgage rates. And that's a good example of the tightening when you go from, 3% to 7% in 6 months on mortgage rates. That's a real significant tightening of conditions very suddenly.
Yeah,
Bill, you had your hand up?
Yeah, I'll leave you this comment. There's performing loans, performing mortgages, credit mortgages, not agency mortgages. They're trading in the 70s that are, 3.5% coupon so they're fine, newly originated mortgages because of the, widening in spreads and rates.
Well, we can lose money in fixed income again now with rates being higher. So we could, we had the opportunity to lose in equities and in public and private. Now we can go back into the public markets for bonds and lose money there too.
That seems like a perfect segue to recognize Bill Deukler.
Yeah, I know. It's like, who in the world would have ever thought that, like, maybe we should think really hard about short-term treasuries? That's like, what a world. But no, great. This is like so good, Stephen. I was asked the title of your presentation just last week, so I'm glad for the backstop. But further also, if you look at reverse repo, kind of coming back out of the closet again, I think kind of the last time it was a topic of conversation in the community. The level was like at 1.4 trillion. Now it's like at 2.2 trillion. And that's just a huge amount of bank reserves that are now sitting over at the Fed because they're paying, very, very sweet rates, on that. But that's also pulling money out of the system as well. And, one of the things that the Fed could do if they wanted to start stealthily easing would be to lower the rate that they're paying on reverse repo and allow that to come back into the system. So, in terms of like other areas, that are tight, that's certainly one. Again, you look at global money supply, the rate of change on that, it's just been plummeting and now is negative. So, there's a lot of global money supply that's coming out of the system as well. And, again, I think this is all just sort of adding up to a magnification of what the Fed is doing here.
Yeah, it's interesting, Bill, when you raise this, I've shown this slide a million times where you had how much the central banks and fiscal authorities around the world added to the monetary system over the last year. And we put 50% of GDP to work, or a third of GDP to work in the system over the last 24 months. That's a massive amount of additional capital being thrown at the global economy. And when you start to see that reverse, that's a big change as well.
Thank you, Bill, for watching reverse repo for us, because I was going to ask you the question. So I knew you'd have the answer.
There you go. My pleasure, Andrew. Yeah, I think Rob's got a question in the chat.
Yep. Rob.
Hey guys, good morning. Thanks. Steve, did you guys, pardon me coming a little later, but did you guys have any commentary with respect to sort of FTX fallout? And in your eyes, is sort of the market reactions as severe or more muted in your views?
I actually have no idea if it should be worse or more or less of a market reaction, to be honest with you. I think we don't know. Joe and who else was talking about it earlier. I think they can answer it better than I could, but
It was Dan and he had to leave us. But happy to introduce the
I think
topic.
when
to the
you're-
group.
there's fraud. I think it's, whenever you have fraud, I think that it's hard to know how bad it's going to be. So Joe, do you want to take that?
Well, again, I think we're getting back to, it sounds really trite, but basic fundamentals, and tell me the fundamentals behind NFT. It's a technology, it's not a value creator. And so those things that people were bidding up was just another example of the bubble mentality of so many of these early crypto traders finding yet another instrument to satisfy that addiction for speculation. But when you got performing mortgages dropping in value by 30%, and that's actually got assets behind it. What are the assets behind an NFT? There is none. So it's more a measure of how much speculation comes out of the system versus, and that is, that's hard to define that bottom. Because those were just instruments of speculation. There was no value associated with them.
I don't know what
That's my read.
mortgages.
I'm not a crypto guy. That's just an observation at a sort of macro level.
I don't know what mortgages Paul was talking about. I'm not looking at that market, but just the duration of a 30-year mortgage times the price change or the yield change should get you to most of that price difference. But I don't look at that stuff. Does anybody have any?
Yeah,
thoughts
you have
on that?
extension. I mean, I'm just talking about non-QM mortgages. So those are non-qualifying, basically
Okay.
non-agency sector of, but good credits, 700 plus FICOs, 75 LTV. So it's just people that are either have, and some jumbos, but it's extension, and it's the securitizations of those were getting all in rate was maybe 3.5% last year. And now it's like, 9%, 8-9%. So you're seeing, and that's the effective. So security and the securitization takeout is not really a very good tool right now. So that you're seeing volumes disappear in terms of securitizations, and whole loan buyers are loving it, right? Guys that just buy whole loans outright are, they're in a position they haven't been in years.
And is hedging, because I know a lot of big banks use the 10-year to hedge a lot of their mortgage exposure. Has that created chaos as well?
Yeah, no one's, I'd say I forgot who said it was like hedging mortgages is an expensive way to trade 10 years. But no one, agency mortgages, obviously people hedge those books. Credit mortgages really have not been hedged effectively for over a decade. And it just it's a lost art, I think, and people really haven't hedged it. So I think that is a piece of, so that's why you've seen a lot of these REITs and finance companies have issues, is because of their the lack of credit, a lack of rate hedging for non-agency product.
What's happened to our system is we become far more fragile financially because of the financialization of so many asset classes. And as Paul pointed out, a generation of people that have largely been trained with the Fed put in place and secular decline in interest rates, and everybody's doing it. And so, the calculations are clear, duration and interest rates, you got to mark them to market. But the second and third derivative is the vulnerability of our system because of even the participants and how they've been trained, the environment they've operated in. And, when you look at, and you go on the equity side as well, where Boeing, through financialization, bought back $100 and something billion of their own stock, and yet needed a bailout when the economy turned south.
Right.
That's how financially fragile we become through financialization, the cautionary tale of what the Fed did. Now, would they have predicted that? No, but irrational financial behavior when they strayed so far from their ultimate mandate, you could predict unintended consequences wouldn't be favorable. That's not brain surgery. And that there's some purported smart people at the Fed and advising the Fed economists. And again, they've all become so politicized as to be more short-term and not concerned about second, third derivative of impacts and consequences.
Joe, it's a great conversation and a great narrative, but the time has come for us to transition to the next component.
Come join our 361 Firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.